Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Bill Baruch. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, Footsie Russell, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on futuresradioshow.com. Today I spoke with the president of Blue Line Futures, Bill Baruch. Bill and I discussed the importance of learning the futures business before you begin trading, how he goes about his slow and steady approach to trading futures, explains his technical and fundamental process, and last but not least, how he day trades around his longer-term core positions. So without further ado, let me take you right to the interview with Bill. Bill, how'd you get involved in futures?
Back in college, my roommate and his father were preaching about gold, and it woke me up. I, at the time, was doing some stock picking with my dad, and we started talking about gold, and we jumped into gold, and loved the way the futures moved, loved the way just getting involved in a commodity, and gold ended up having a great stretch. But at that time in college, I was coming out of college afterwards and working at a investment bank, and it was more the slow, monotonous work, especially coming out of college and being in an investment bank. But from there, I really wanted to be in front of the screen, wanted more of a thrill in the day-to-day activity. And I was in Baltimore there, and I took a interview out in Chicago at Lynn Waldock, and really the rest is history.
So moved from Baltimore to Chicago, took a job at Lynn Waldock. That's where I started too, and many of my trader friends also started at Lynn Waldock. So let's fast forward a little bit. Talk to us about what you were doing at Lynn Waldock and a little bit about what you're doing right now with Blue Line Futures.
Okay. Yeah, I had taken a job as a junior broker there, and luckily I had was assigned to work under somebody that loved gold as well, somebody that had a lot of experience in the business, somebody that had made a good transition from being a floor broker into looking at the screens, understanding the technicals behind the screens, and I was able to learn a lot from him. And it put me in a good space to move up within Lynn Waldock, and Lynn Waldock became MF Global. I was running my own desk there, and when MF Global had collapsed, I was able to leave and start a company with a partner of mine. But moving into Blue Line Futures, I was at that partnership and heading into 2017, and my wife was 9 months pregnant at the time, and I told her I'm starting my own company. I had a vision of the way I wanted to get my message to clients, the way I wanted to be able to, work and build a company. And she gave me her blessing, 9 months pregnant and all. And I, 2 years ago, so started Blue Line Futures, and we're growing. I love every minute of it, and I think the future is extremely bright.
So now you're a broker and a trader. I'm curious, what was the biggest thing you took from working at a broker before you started to trade?
I would see, it was nice to be able to be young and learn what a lot of the people are doing, and seeing a lot of different strategies that are out there. Again, I was very lucky to be under somebody that had a process of his own, but as well seeing a lot of what clients had done. And one of the things that I always kept seeing more and more was obviously people taking a lot of leverage early in their account and over leveraging their account, which was cause a quick demise, or people that had deep pockets that would sit through moves and be wrong for a very long time and continue to send more money, being a little too over leveraged as well as part of it, but sitting through moves for a very long time with no protection or no stop and sending money, and then eventually the market would turn and they would see that that it would work out for them. It would instill a belief that the market would always work out for them. But everybody knows that this, you can only dodge bullets for so long. So understanding a risk management strategy became something that I really wanted to walk away and I took away with.
Yeah, that's why I believe it's so important to either work in the industry before you begin to trade or do extensive education, sit back and watch the markets for a little bit, watch other people trading the markets, because that's a big lesson that you learned. And I know from talking to you a little bit, your process now is really the slow and steady approach. And in conversations that we've had in the past, you said, you know what, one of the things you focus on is you don't have to be right now.
Yes.
Talk to us about your process.
I like to look at it as, again, you don't have to be right now. People, we have a wide range of clients here at Blue Line Futures, and again, I still see it to this day. People over leveraging, people not taking it, and not planning out very well, and that's, your account's a business, and you got to have that plan. So one of the ways I personally trade, and one of the ways I try to instill in my clients as well is to not over leverage. For instance, I'd like to use the example of a $100,000 account using 2 or 3 contracts. And by going that route, you don't have to be right today. You don't have to be right tomorrow either. You have to understand where your threshold of pain is and how much you want to risk on the trade. And you do want to be able to have that management style always. How much are you risking on one trade? Sort of move through each trade, and you're being consistent with it. But another way too is if you're not over leveraging, you're only using 2 or 3 contracts per $100,000, and you can always use protection on those. One of the trades that really stood out to me, one of the things I really like to look at, and in my process, is the commitment of traders and where is that the supply demand technicals are. So I last year, gold, it went a net short, and managed money net short, which is very rare for gold, and that was a great buy signal. But at the time, gold was felt like it was free falling. It was a little bit of a bottoming process, but would that next leg be down? There was a number of conflicting fundamentals. Was the Chinese yuan going to weaken further, and was that going to drive gold? Was the Fed going to tighten policy further, or was that going to drive gold lower? What was the catalyst that turned gold ultimately? But if you wanted to step in gold when it was below 1,200, ultimately you could always use some sort of protection. So if you had a $100,000 account and you were buying gold and using puts to protect it, you didn't have to be right today. You didn't have to be right tomorrow. You had to give yourself a decent time frame, whether that be 30 days or 45 days, to see your trade play out, manage the risk. At some point, if gold did go lower, where's your tap out point? And like I said a minute ago, to be consistent with your trades in that and how much you are risking. Another one too was the treasuries, and I pushed that one to the brink with myself and clients, but was the leverage net short position and treasuries is, it's still to this day just a record. Basically, it's a massive net short position. I'm extremely surprised that even after such a rally over the past year, that it's still such a net short position right now. But overall, that net short position, for me was. I'm a believer that rates are lower for longer over a long period of time, and I did think that as the 10-year approached to that 3% threshold, the 3.25% threshold, it was a tremendous fade on the yield side and a tremendous buy on the price side. So looking at those, we didn't know where it was going to stop and where that bottom was going to be. So it was a great strategy to be able to use puts to protect it as we built a position, whether it be some people in the 10 years, myself, or the 30 years. And then wait for it to turn, and obviously it turned. It hasn't looked back really since that October bottoming and turn of last year. I remember I was at the Ryder Cup with my dad last year, and those are some of the days that early, and it was outside of Paris at the time. And those are some of the days that the Treasury were putting that low in, and I had to go get connectivity that morning to make sure everything was okay, position size wise and protection wise to the downside. But it worked out, and I didn't have to be right that day, and it took 30 to 60 days to find that thing to bottom, and it ended up being probably the best trade of the year. I definitely, gold ended up performing fairly well as well, but not having to be right now gives you a lot of flexibility in your trading strategy.
I agree. There's a couple things I want to talk about. I think this is a great process for new traders. You don't have to use the leverage. I mean, this is one of the major reasons why I was so excited to see the micros come, because I think that not everybody could come in, as you used an example, $100,000 account. Not everybody will have that. So now if they have a smaller account, they can use the micros. And I think for new traders, by having the attitude, you don't have to be right now, it lowers expectations, because I think expectations when traders come in to trade futures right away are just too high. I think
absolutely
they get them into a lot of trouble. And I also think it takes a lot of pressure off. It extends their time in the business, which is extremely important. And so let's talk specifically about some of the technicals that you use.
I like to start off looking at a daily. I mean, as somebody who takes a more fundamental approach on the long term, and again, my fundamental approach is, where do I expect things the next 3 months? How do I think they're going to play out? And really, how is that going to drive the next 3 to 5% of the market? From there, do the technicals confirm that? Do the supply to demand technicals, does the commitment of traders, allow for the market for positioning for people? If everybody's already bought, who's left to buy? If everybody's already sold, who's left to sell? So does the commitment of traders encourage that path of least resistance, or will it act like a headwind? And that's one of the places that I start. And then from there, I just like to keep things very simple and technicals. I mean, on the daily chart, where's the 50-day moving average and where's the 200-day moving average? Is there momentum? Is the 50-day below the market, and is the 200-day below that? And is this going to help basically bring a tailwind to the market? From there, where would that resistance come in if that is a tailwind? Are we seeing a retracement level in a certain area? Is there a previous breakdown or a volume pocket that's going to act like it? So again, I try to keep things very simple. If I start getting more micro into the 30-minute and hourly charts, I'm looking at more specifically, for the S&P, where are the previous gaps? Where are some of the volume pockets? Where did other news come out that was very significant that caused spikes in volumes? I keep things very simple, and some of the retracements levels as just targets, because I think time and time again you do see retracement levels, at least if not reverse a market, at least just stop a market and stall a market for a bit.
So you start off with the fundamental theme, right? That's what it sounds like. You have a theme as to where you think the fundamentals are going to take a market or should take a market. And then you go to your technicals, and it sounds like you're using pretty basic stuff, and you're primarily using a daily chart.
Yeah, I started a daily chart, and then I'll work down to an hourly and a 30-minute. But I'm looking at the daily chart to understand where the market has been and where could it be going.
Let's go over a recent trade example. Take us from the point of determining fundamental analysis, then going to the charts, and then pulling the trigger on a trade.
Okay, so if I think one of the best examples outside of if you really want to get long-term approach on things, one of the best examples right now is what we're seeing here at the end of August develop in the S&P. You got extremely strong resistance, and we've had this as our major 3-star level on our research for clients, but it's 29.32 to 29.44. And that we've had that since the breakdown. And not only that, you have the 50-day moving average coming in up there. And if we were to close out above there, I mean, you'd have to be long. Even if you were bearish fundamentally in the market, there's going to be a tremendous tailwind behind that. In the same way that we do have the 200-day moving average and a lot of support down 28.11 and 2800. And you would think that if we start closing down below that, some of those lows, we're going to be breaking down, and it could get ugly. Not only that, we're starting to see where's the market been in the past, and where is the market? Where could it go now? And you're seeing some of those similar chop back and forth in this range, similar to what we saw in October and December. The way that we saw a ceiling develop previously in October last year, and then November, and there was that triple top. But was never really breaking down. The range was larger, but a very similar back and forth and ricocheting between those support and resistance areas. So we're seeing that. We've seen it before just recently, where you get this thing going back and forth, and there's going to be a directional move. I think planning for that, again, you don't have to have a trade on right now. You don't always have to be in the market either. So planning on something like that, planning on that move, are we going to break out above that resistance level, 2930, 2940, or are we going to break down below 2800 and looking to capture whatever tailwind from that you can? And then once you get that tailwind, then you can start getting more micro on it. You can start getting at where are some of the levels. And I mean, I find myself sometimes, I'm not afraid to trade a little smaller time frame if I find myself in a trade. Going back to the bond trade of last year, battling a bit with some protection on a core position of futures. Yeah, there's certainly days that the market feels like it's going to bottom out and it's going to turn, and there's trading opportunities within that. But I like to look at things with a core position that I don't have to be, you don't have to be right now, but as well, you can take a look at adding a contract or two per that 100,000 on an intraday or a 2-day time frame with a stop on there, and being able to know that feel very confident because you're really focused on the direction of this market, and this is all you're looking at and all you're trading right now.
Hey everybody, I want to take a moment to thank one of our sponsors, Footsie Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 Index futures, contract symbol RTY. For more information on Footsie Russell and their products, please visit footsierussell.com. I want to focus a little bit more on the execution. So I get an overall idea of what you're looking at. Like we said, fundamental theme, then you go to your daily charts, see if it fits in with your fundamental theme. If it does, then you might narrow the time frame down a little bit, and then you'll go in and you'll trade at some levels that you have. Mm-hmm. You mentioned to me that you really look for the next 3 to 5% move. So I'm curious, how are you determining a stop? Is it 1-to-1? And also talk to us about targets and a little more info on how you use options.
I think stops, you want to be able to align what you're looking at, and you want it to make sense. So, I mean, I've seen people before, and I have no problem as well reiterating to clients too in using a stop that's an exact amount of money. But at the same time too, you also want to make sure you're not leaving yourself to get chopped too. I mean, you have to have some sort of you want to have some reasoning behind the madness, and I guess you could say, but I like using protection in the market. So if you are buying, like again with the gold trade last year or the treasury trade, you are buying against for that longer term reason, but you're also protecting it with puts. So where you're able to mentally give yourself more room than you typically could, knowing that okay, you have a 20 or 30 delta put on that's going to increase in value if you're wrong, and then it's going to also cover a chunk of that loss too. So you plan for that, and I think ultimately, if you're looking at something like a $2,500 risk per contract, and you have a $100,000 account, and you're doing 2 or 3 contracts, but you feel confident that you can cover a third of that loss, and the options that you may have in a longer term time frame, you at least have a process there, and not only so. There could really be crucial levels outside within that $2,500 risk per contract area that you don't need to sit through it just to wait for something to break down. Something, I mean, especially in such a headline-driven day, can change on a daily basis. That's why you put research out every day. That even though we may not doing something in that market each day, but there's new news, there's new developments, there's new things changing that. You can't just wear blinders to trade just because you're in a trade. And I always tell clients, and I always try to remind myself that just because you're in something doesn't mean you need to stay in it. And it's okay to be wrong. I mean, how long? It's just a matter of how long you stay wrong. So that's one of the things that you want to incorporate. So if you get into a trade and you're eyeing, okay, this is how much I'm going to risk on it. I'm going to risk 5% of my portfolio on this trade, or 3% of my portfolio on this trade. But you don't have to sit there and be in it and wait to be wrong for 5%, knowing that for the last several days this market is just breaking down and going against you.
Yeah, it's okay to be wrong. It's not okay to stay wrong. So it sounds to me with your slow and steady approach, a big part of your execution is low leverage and then use options as well.
Correct. Yeah. And I mean, I think if you're honest with yourself, you can really have a hard mental stop of where you'd want to be out of the market if it broke. But at the same time, that option gives you the leeway to be more patient with that trade to come to fruition. I mean, there's a lot of times I also like to look at a closing level. A lot of time the market will go down intraday somewhere, but it's not closing down there. So that's something I think is very important too, is seeing where the market closes. And you may have we use 3 stars for our levels here, and you may have a 3-star support level that's well ahead of where your mental stop would be if it happened intraday. But you're able to let it close below there, and then your options making some money back for you, and then you say this isn't working. I want to get out of it. You can be wrong. Before some of the bigger levels are breached, something can change. I think that's important to recognize and be honest with yourself.
Can you talk to us a little bit more about how you're using the options market? For example, if you're long, are you just buying puts? What puts are you buying? How far out are you going? Are you rolling those options out? Just talk to us a little bit about that process.
Well, you want to give yourself, like I said, you don't have to be right now, but you do want to give yourself a time frame. I mean, is that time frame 45 days? Is it time 60 days? Is that time frame 30 days? Ultimately, you want to define your time frame, because if you have to be right within some point, but it does not have to be right now. And from there, you want to look at an option that gives you enough value in that time frame, and then after that, you want to find something that's going to be somewhere in the ballpark of a 30 delta. That way, you're cutting your loss by a third. And on top of that, you're also as it goes against you, it's going to be picking up too. So I think that's also important. That's generally speaking, because there's going to be different time frames you're using that are going to cost different amounts as well. And when things rally your way, and I'm using the word rally because I mentioned treasuries and gold in my mind right now. But if something were rallying your way and you have 2 or 3 contracts on, what's to say you can't sell a call against one of them? I mean, and bring in some of that money to cover some of that premium, or roll up something into that. So ultimately, I think there's a way to be able to, I want to stay in the market for a while. If you're going to be risking that, $2,500 a contract, or which hopefully would be end up being less because you're coming to terms with the fact that the trade is wrong. But if you're risking that, you want to be able to stay in a trade for a while. You want to be able to give yourself the staying power and catch that move. I mean, look what gold has done this year, and I mean we're out of 1550. I mean it's been a really heck of a move. If you're able to stay with stuff and let the trend and just ride the trend, those $2,500 risk per contract, I mean, they become nothing if you ride gold for $150.
I think we all understand now how you go about your slow and steady approach. You're using options and futures. And one thing I'm curious about, you mentioned earlier about looking at the lower time frames and doing some intraday trading. So once you have this core position on, are you trading intraday around these core positions?
Absolutely. I mean, I'm not sitting here, and no one really is, or no one really should too, but you're not sitting here trading 10 different markets at once. You have different things in your radar. But when I get entrenched in a certain trade, which last year, gold and treasuries was really a lot of my focus, for it's really still into this year, is you're just know you begin to know that market and its movement just like the back of your hand on a daily basis. And even though I don't really want to be trading a short time frame, you end up seeing opportunities that present themselves, and that's where being patient and being strategic. Some of those lower time frames, even if it's not your major focus, you're going to find a $10 swing in gold, or at least you can jump into something and have a little more of a well-defined stop for a shorter term risk on it, because you're now in this, you have this core position in the trade, and you're watching it, and you're hopefully catching a wave, and you're letting the momentum play out.
Yeah, I mean, what's happening with you, it sounds as though you have your fundamental bias, you have the technicals to either prove or disprove your fundamental bias, then you have your position on that you don't have to be right now, and
Correct.
Then you look at the shorter time frames while you're carrying this position, and all of a sudden an opportunity comes up intraday, and you're like, hey, you know what, I could actually trade this, and you're just going to trade with that same bias that you had, because now you have price opportunity to trade in the shorter term, but it doesn't impact that longer term position. And
yes,
what I like about that is it creates patience in between day trades, because you have something on, right? You've got skin in the game and where you think the market's going. And then when the market gets back to an area that you feel is really important, you could go ahead and trade and put some risk on there again. And you're not forcing stuff in between there. At least that's the goal, right?
Yes, yes.
Yeah, no, I love it. No, great stuff, Bill, but we're not done yet. We have rapid fire questions next if you're ready for those.
Yep, I'm ready.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You can try it now for free at tryttnow.com. Bill, first question for you. What traders influenced your life the most and why?
It may sound cliche, but David Tepper, it really stood out to me in September 2010. It was more the comments. Obviously, he's had a lot of success, but the comments he made in September 2010 amidst uncertainty and volatility in the market. And he was on CNBC, and he said stocks are going to go higher because the Fed accommodation or good fundamentals. And it really gave me, it really started to invigorate my look into the perception of the market and how the market can move in perception. And not only that, tying it in, I mentioned earlier, supply and demand technicals. I think a lot of that works together. Those comments had a great impact on the way I look at the market.
What was one of the hardest things for you to overcome in trading?
I had a CTA back in 2014, and coming out of MF Global, I had a lot of success. I've talked about gold, for a long time, and gold had that first move up to 1,900. I had a lot of success for myself and clients as well, and it really felt like I was on top of the moon. As well, I started a CTA in 2014, and these are six figures amount of money we're talking about. And I was able to go up 100% and in the first year. I felt like nothing could stop me, but I didn't feel like I came to the realization my process wasn't right. And when August 2015 rolled around, my risk wasn't right. I got away from some of the things that had been working because I was too confident in myself. So I was extremely naive, and I took a hit. The CTA was up 100% in the first year, but overall we took a 25% drawdown, and it took a couple swings on things and put the CTA to rest. But ultimately, it was a wake-up call to me that I needed to get my process better and be able to realize how naive I was.
How has your trading process evolved over the years?
I think early on, when I talked about wanting that thrill and coming into the futures and commodities markets, I wanted to be a short-term trader. I wanted to be able to just trade these small time frames and small pockets. And I did do that, early on. But as I've described, my development, especially the CTA I just mentioned, it's really encouraged my development into not having to be right now. So I'm going from looking at that 5-minute chart and then double checking that 5-minute against the 30-minute, and now I'm more that top down. What's my fundamental approach on the larger theme I'm looking at, and then work down into the technicals from there. So that's how I've moved over the years.
What is one attribute you believe every trader should have?
Patience. There's no question about it. You need patience.
Favorite book about trading?
Now, it's not necessarily my favorite book, but it's had a great impact this year. Is Thinking in Bets, Annie Duke, and she talks about admitting that you don't know something, and I think there's a lot of very impactful words. So. I in there talked about not knowing and admitting you don't know something, and how enlightenment can come from that. So I think I use that not only in trading and being able to admit that I don't know something, but life as well, and family and friends, admitting, and I think in our day and age, admitting you don't know something is shunned upon. So I think that's had a good impact on me this year.
If you had to pick a profession other than trading, what would it be?
Farming. From pushing numbers around a screen and, for better part of my life, I'd like to be able or look back and know that I contributed something to my community and had a larger impact.
What's the best piece of advice that you received about trading?
It's okay to be wrong. It's just a matter of how long you stay wrong. And that goes back to some of the things that I saw at, working at MF Global and seeing some of the clients there that could just sit through moves and be wrong for very long periods of time. It was something that mistakes I made in 2015, mentioning that CTA in August. So I think that's one of the biggest things is it's okay to be wrong, but how long you're staying wrong, that's where it matters.
If you could give a piece of advice to the younger you, what would it be?
It's something that have really stood out to me this year and started learning more about last year is option skew. So not only using options to hedge futures bets, but really trying to find opportunities in the option skew. I think that's something that I wish I had learned 10 years ago and have been able to master by now. But I think that's definitely a great complement to any portfolio.
If you had an elevator pitch me your edge in trading, what would you say?
As we mentioned, the top-down fundamental approach on things and being able to be patient, look at the larger picture. That's where I think I capitalize the most on top-down, strong fundamental bias. What are your risk parameters, and not having to be right now.
Last question for today. Favorite thing to do when you're not working?
Well, in a family, I got 2 young daughters, 2 under 2, and they're a blessing to come home to and everything. But so I don't have a time to do a whole lot else. But golf, I haven't played much for it, but I love golf. I love getting a run in or going to the gym and lift weights. So that's what I'll do. I'm not at the desk here.
Where can people find you on social media, and give us a website to check out?
Well, BlueLineFutures.com. is our website, and on social media, my Twitter is @Bill_Baruch. It's Baruch. You can find us there. We put our content up online on our website all the time. We're updating things as well.
Bill, thank you so much for joining me on Futures Radio Show.
Thank you for having me.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.